Hi, I'm John Cavill and I'm a business angel, and I'm going to talk to you about various aspects of business angels and business angel investing. So business angels are high net worth individuals who generally have had their own businesses, started their own business and probably exited those businesses and created some wealth in their own right, which they then decide to invest in other perhaps similar businesses with a view to helping those businesses grow and to create an additional capital gain for themselves. So it tends to be people at later stages in their career when they would have had the opportunity to build some capital assets over a period of time. Well, they look to invest for a number of reasons, I think. They may have created enough wealth themselves where they don't need to continue working, and they look for an opportunity to get involved in an entrepreneurial activity of some shape or form. They've probably developed a great number of useful contacts, a lot of business skill, business acumen, and they feel that it's perhaps an opportunity to give something back, as well as an opportunity to actually create some additional wealth. Well, business angels would normally invest at early stage, not necessarily right at the seed stage, which is generally the domain of family, friends and the founders themselves. So it's normally at a stage where a product or a service has actually been defined and perhaps developed. They may already have some initial orders, or first customer ship may have already been made. So it's not right at day one, it's certainly at some time later, but still at a stage where there's some level of risk involved, and that's something that the business angel obviously is aware of and needs to be able to assess what the real opportunity is for them in terms of making a real return. So it has to be high growth opportunity, not a lifestyle business or perhaps a small family business. They're really only interested in high growth opportunities because that's the only way they're going to get their return. Well, venture capitalists are generally managing a fund, a venture capital fund, and the investors in that fund could be anything from individuals to organizations, and they generally are only interested in investing large amounts of money. So probably £2 million plus. Anything less than that it's really not worth them getting involved, because the cost of actually managing investments, small investments, is too great. Well, I think the important thing with business angels is that they bring what's normally referred to as smart money. So it's not just cash to help the business move forward. You're actually bringing to the party the knowledge that these individuals have, that they've been able to build up through their own careers. That may be a network of very valuable contacts. It may be know-how in terms of a technology. It may be just general business acumen as to how to structure and build a business. So it's a combination of things that they bring to the party. Unlike family and friend investors, business angels normally have no contact or connection directly to the businesses. So they come to them quite new and quite fresh. Business angels typically make between 1 and 3 investments over a 3-year period. So it's not something they're doing every other month, for instance. And they are very selective in terms of the investments that they make. Normally business angels would also only invest in their local area. So they probably would not invest in any organization that was more than 100 miles distant from them, because they need to be able to travel and for meetings and any other sort of involvement that they may have with the business. A key criteria, I think, for business angels is that any investment that they look at getting involved in actually is registered for EIS relief, because this has a great value attached to it. An investment over £500 or up to £400,000 a year is actually eligible for tax relief at 20%. It's quite a considerable amount of money. And capital gain, once the business is exited, has no capital gains tax. So if a company doesn't have that in place, then it's actually going to go against them quite severely, I think, in terms of gaining the interest of business angels. And in fact, they'll find that one of the first questions that gets asked by business angels, are you actually registered for EIS? Business angel investing comes in a number of forms, I think. There are individual investors. There are individuals that may get together in a small group or a small syndicate, and they may actually invest in their own right, or they may actually invest alongside an existing fund, so they will share the risk in effect. Business angels will generally invest between £10,000 and £750,000, so it's quite a spread there in terms of the levels of investment that are made. In some cases you'll find that teams or syndicates will get together and they'll be able to raise enough money to cover the investment requirements of the business, which mean that they don't necessarily have to go on to raise venture capital investment, that the syndicate itself could actually fund the business up till exit. So if you can find somebody that actually has that capability or has a network to actually draw additional angels in at a later date, it certainly makes life easier for them in terms of raising later stage funding. So one of the key reasons that this would happen is that business angels really want to avoid being diluted by venture capital that's actually coming along at a later stage and restructuring the funding, because that obviously has a detrimental effect in terms of the value that can be generated. So if angels can actually get together and fund it right the way through to exit, then that's far more beneficial for them and something worth considering when you're trying to determine who you should go with and what access they have to additional funds, because there are very few, I can't think of any companies that can actually last with a single round of funding. Money tends to go much quicker than people ever imagine, and it's always needing second, third and possibly fourth rounds of funding before exit can actually be reached. And there are circumstances where the amounts of money that needs to be raised is so great that it's not possible for business angel networks to actually be able to raise that amount. So they have to accept that there may be some dilution, but hopefully the value that will be created is so great that the return that they will get will still be well worth the investment that they've made.